Welcome all. Welcome to the first assignment unpacking video. This would be for the assignment that was due on Sunday. So for unit one, let's go through what the required was, what the expected answers also were, right? I will also go over in terms of how to specifically read certain requireds or requirements so that you understand exactly what you are being tested on, because it is important for you to understand exactly what the question requires from you in order for you to attempt it successfully. I think that's one of the most important things that you should be learning throughout your course, and especially for this module, seeing as there are SEMA verbs that guide you in terms of answering questions, right? We'll go through that as the slides progress. So the required for this specific assignment was to talk about Mutlakatsi Renewable Energy Limited, that was established 12 years ago by two electrical engineers, Naledi Mukwena and Spusiso Dlamini. The company designs, manufactures, and installs commercial-scale solar energy storage systems for shopping centers, hospitals, and other businesses across South Africa. Due to its increasing demand for renewable energy solutions, Mutlakasi intends constructing a new manufacturing facility in Gauteng, costing approximately 48 million. So based on this, you can tell that there is a new type of investment that the company needs to make, right? With new investments, we always know that there's going to be a need for capital, and with that acquiring capital comes with a cost, right? So now you actually understand from last year that acquiring capital requires you to also accumulate costs. So if you are acquiring capital via equity, there are costs that are involved. So then you can calculate your costs using the dividend growth model and the CAPM model, right? Given on what information that you have been given, right? And then you know that also when you're acquiring financing through debt, it's long-term debt, which would include your bonds and debentures. And also you know that those come with a cost, and also there are ways to calculate for those costs, right? But this information in the scenario is also quite important for when we get to questions like evaluate or discuss or explain, right? Because then you need to know the makings of the business and what the business is trying to establish with this new investment, right? So if you can understand where the company is coming from, then you are better to explain what it means for the board of directors when they want to make a particular decision, or what it means for the direction of the strategy of the company, right? So please read this information. It is important. It becomes important when we start asking you questions like evaluate and discuss and explain, right? As opposed to calculate. Sometimes evaluate also does come with calculations, because you have to calculate in order for you to evaluate whether a decision is good or bad. But also it's always driven by the fact that the company is trying to achieve this particular strategy. So based to get that strategy, to get the understanding of the goal, you have to make sure that you read the scenario as carefully as possible, right? The directors are debating whether the expansion should be financed mainly through additional debt or equity. So we are looking at that debate probably coming on later. So what would be the things that influence your ability to get debt, your ability to get equity, and should something be financed more by debt or more by equity, right? That can only come through by weighing out the costs of each, right? The chief financial officer, Peggy Ngumalo, recently attended Finance Indaba conference and believes that the Mutlakasi should substantially increase the gearing to reduce the firm's weighted average cost of capital, since debt is generally cheaper than equity, right? So we understand the theory of debt being cheaper than equity, right? we also understand how it's for investors also, debt is a less riskier investment than equity is, right? However, the chairperson of the board is concerned that excessive borrowing may expose the company to financial distress and increase the likelihood of bankruptcy costs, especially given the uncertain economic environment and rising interest rates. So you are being told that within the conversations that are happening, there's a conversation about increasing the debt, so therefore your debt to equity ratio, your gearing, is going to be high, and the consequences that come with a high debt to equity ratio would be the fact that borrowing is going to be a lot more difficult in the future because you've got such a high gearing. Also, people will be likely to not invest in your equity because of your gearing is so high, because then you know that as investors you want to get a return. But if a company has to focus on their debt before they do their equity, and if their debt to equity ratio is so high, then it means that a lot of the investments returns will be focused on giving the people who have debt holdings first before the equity. So then therefore there is that disadvantage, right? But also, not only that, it also says that it exposes the company to financial distress and increase in the likelihood of bankruptcy. So now you need to also understand that maybe along the way you might be asked a question about the risks that are involved with debts that will include bankruptcy costs, especially given, and you are also told that the economic environment is uncertain and there are rising interest rates. So these are alarming risks that are coming forward. So when you have these discussions, when they ask you to discuss the support or lack of support towards increasing gearing, you could use these things as a guideline to say that, hey, we are told that the economy is uncertain, so therefore it could be not a good idea for us to invest in more debt. Also, increasing the interest rates will then mean that there is an increase in the cost of that debt, right? So the company may not be doing so well then if it has to focus on paying off debts from investments that they are making in order for them to maximize shareholder wealth. So it's basically just working backwards, working for debts, right? Then it carries on and says, you are the senior officer who is responsible for evaluating Motlakasi's current cost of capital and and advising management on his proposed financial strategy, right? So you are given the book values of the following: the ordinary shares, the preference shares, debentures, long-term bank loan, and the bank overdraft. So here are the sources of finance. They have been given to you, and the book values and the market values also have been given to you, right, of each. And then here are the additional notes. It tells you that the par value of ordinary shares currently is in issue at 1 Rand per share. The company has recently paid an ordinary dividend of 0.72% per share, and management expects dividends to grow at a constant rate of 6% per annum indefinitely. So you know that here we are looking at your dividend growth model to find either the cost of the pricing of the share currently, or to find the dividend moving forward, so that you can find the cost of equity, right? Just a foreshadowing, we know now that we're going to have to calculate one portion of the cost of equity and another second portion using a different formula, which is a comparable listed renewable energy company, Greenvault, has a required rate of return of 15.2 and an equity beta of 1.3, while Motlakase has an estimated equity beta of 1.05. So given this information, you know that you're going to be using the CAPM formula as well to find your cost of equity, right? Then you know that once you have to use both formulas, the DGM, the dividend growth model, as well as the CAPM formula, then it means that you're going to have to find the average cost of equity, right? And that is what you're going to be using to calculate your WACC. So once you read this, you can assume some questions that may arise in the required before you even get to the required, right? Preference shares were issued at par value of 100 Rand and a 10% fixed annual dividend. These preference shares are currently trading at 5% discount to par. And then the company has issued 7-year debentures on face value. So this is information regarding your preference shares and how to calculate and your debentures, as well as the long-term loan that exists, right? And then we also know that the bank overdraft is a short-term working capital need, so therefore it's not included in your weighted average cost of capital. Please make sure that you make note when you do your WACC calculation that, hey, short-term does not belong under here, right? And then we've got additional information for us to use in various places. So this video took about 11 minutes long. So before we get into the nitty gritties of it, I just wanted to give you this introduction. I'm going to make a part 2 where we actually discuss the required and what each bit of the required needed for you to do or needed for you to look out for in order for you to answer the question properly, as well as going through the memo. All right.